Welcome to another episode. My name's Jose Najarro, and today we're going to take a look at a company called Cerence. They just did their Q4 earnings. Their ticker is CRNC Stock. This is a brand new company, and it was introduced by someone in the comments, and I'm glad they suggested this company. Like always, I have my buddies Darth Bear, actually Bull Solo, and Darth Bear ready to keep track to see how the company's doing. So let's get started. So before I begin, all the information comes from either CRNC's investors website, Seeking Alpha, Market Watch, and Lazy FA. So feel free to check out those websites if you guys want to do any more research. In their CRNC investors website, you will find their 10K report. One thing that you guys will find out about this company, this is a brand new company. It was chosen by Usama Pick, I'm pretty sure. Hopefully I'm saying that correctly. He posted on one of my previous videos for NVIDIA. He was like, hey, Jose, thanks for your time and effort you do for us here on YouTube. After watching this video, my interest went to a company who is focused on making cars smart. The name of the company is Cerence, a spin-off of Nuance Communications. I would appreciate if you have some spare time and interest to analyze the company. I obviously enjoy doing companies that have to do with technology because those are the companies I understand the most based on my education background. So I love doing companies like this. So I'm happy Usama ended up suggesting this company. I'm a few days late. I was supposed to post this video yesterday, but I've been sick. My wife and I have been sick here. We've been just sleeping, watching TV, binge watching. I'm still a little sick, but I've been trying to work on it, and I'm a day late, but I hope you guys enjoy this video. Like Usama mentioned, this is a spin-off of a company from Nuance. So this is their first quarter that this company is reporting. So this is a little tricky. It is a brand new public company because it's spun out of this Nuance communication company, which is a big software company. So one thing, it is harder to find a little bit more information when a company is a brand new public traded. So that's one of the difficulties I had today. I had getting the information for this company. So before we begin, I want to introduce what this company does and what they do. Like Usama mentioned, this is a company that tries to make vehicles smarter. They create solutions to have better interactions between the driver, the passengers, and the car with the digital world. They possess one of the world's most popular software platforms for building automotive virtual assistants. Their customers include all major OEMs on their, which you'll see BMW, Mercedes, Volkswagens. They generate revenue through mainly 3 to 4 ways. The first one is they sell software licenses the main way is they sell software licenses and cloud connected services. And then they sell them through these 3 ways. They have a software components that they typically are sold per unit. So for each unit that goes per car, they collect revenue for each car. Then they have this licensed Cloud Connect software, which is usually paid in advance by the OEM of the car supplier. And these is more like, it's not an individual base. This is more like a grant cloud software. And then they also generate professional service revenue from work with customers where they do during the design, development, and deployment phase of the vehicle, model life, and through maintenance and enhancement projects. So they're in all different stages between the car industry. And they have existing relationships with all major OEMs, and their customer contracts are usually pretty wide and lengthy. So they're able to know like they're multi-year engagements, so it gives them a visibility into future revenue, which I think is pretty good, right? It's good to understand what kind of money is coming into the company. So I really like what the company does and how it generates its revenue. So let's get started. So first, let's just take a look at stock returns. Like I mentioned, right, this is a brand new company, and so this company has returned a nice amount of returns in the past month alone. That it's past 3 months alone is giving up 65%. I wish I would have seen this company earlier on because right now it's definitely up there in the price. Next, let's take a look at revenue. Like I mentioned, their last quarter earnings was the first quarter. It was in December 17th that they reported. This was the first quarter that they ever reported in as a public company, so not much information is yet. The first thing that they do is they beat revenue which was 84 million. They beat revenue by 1 million, which is a decent thing. The next thing is revenue for this quarter is up 10.1% compared to the same time last year. So obviously for the first point is gonna have to go to Bull Solo. And you're like saying, Jose, how can they beat revenue compared to the same time last year, even though this is the first time this company has just reported its public earnings? Well, the company, it is like, just because it's just the first time it's reported public earnings doesn't mean that it's the first time this company has been doing work, right? They have unaudited information from previous quarters of how they've been doing before they went public, and that's what they're comparing it to. Obviously, you have to take stuff like that with a grain of salt sometimes. So this is why when looking into this company, you're gonna see later on, I'm gonna give this, I would give usually a technology company, I'm usually okay with the 25 PE ratio because I do believe technology companies are one of the strongest, fastest growers in my mind, and they're companies that I understand. But because this is a brand new company and because this is, I have very low information about them, I do release the amount of PE that I'm willing to pay for this company, and that's what we're going to see later on. But right now, revenue is up compared to the same time last year. So like I said, first point goes to Bull Solo. So next, we're going to take a look at comparable sales. Another thing that we're going to see is previously this company, if you take a look at their 10Q report and 10K report, this company used to report between with a rule, an accounting rule 605. And now that they became a public company, they're moving into a 606. So anything after this quarter, they're going to start reporting using the 606 rule. But for me to be able to compare apples to apples, they did keep the 605 rules for just this quarter alone. So like that, we can get to visualize how things are really progressing. For this video, I'm going to take a look at their 605 rule, just again to be able to match the apples to apples with previous quarters, right? They have information here from 2018 and 2017. And this is, since there was their quarter four, we're actually going to be looking at the total fiscal year of 2019, the total fiscal year of 18, and the total fiscal year of 2017. So the first thing we're going to take a look is total revenues. Total revenues does seem to increasing every year, right? 2017 was $244 million. Right now it's 2018 was 276 million, and right now we're sitting at 306 million dollars, an increase of up to 11%. So that's pretty good in my mind. It's always good to see uptrend in total revenue. At the same time, we're seeing that gross profit also increasing, which is also a good thing. One thing you're going to see here is net income in 2017 was $47 million. In 2018 was only a $5 million. From 47, it dropped down to 5 million. And in 2019, from 5 million, it jumped up all the way to 102 million. And people are going to be like, hey, wow, those are some crazy returns on net income. But this is why we take a look at their 10Q report, right? They benefit about $87 million from income taxes, right? So it seems where they got a nice income tax refund of $87 million, right? It might not be it doesn't mean it has to be a refund. It means that they might just have to pay that much amount of money, so it counts to them as an asset. But that's a big reason why net income did increase. So I instead of looking at net income, I want to take a look at income from operations, which does not count income taxes. And we can see, sadly, income from operations has seemed to be decreasing over the past years. In 2017, this company made $63 million from operations. And 2018, it made $36 million. And 2019, it dropped down to $14 million. So that's definitely not a good thing. Next, we're going to take a look at deferred revenue. So for those that don't know, deferred revenue means that this company has collected cash from its customer, but it has yet to release the item to the customers. And sometimes it's because it's a timely matter. They get paid up front, but the item doesn't get released till like the next 2-3 months. And that's I like deferred revenue because it means money is coming in and they have and they have to produce some form of asset of item to the customer in the meantime. And I don't think this company is not going to provide that company with the asset, so that's always good. And deferred revenue keeps going up, so this company has a huge backlog of items that it needs to provide to its customers, and it has the money coming in, so that's definitely a good thing. Deferred revenue in 2017 was 300 million. Right now in 2019 is 362 million. So this company has plenty of backlog to be able to maintain at least for the next few quarters. Next, another thing I'm not liking is operating margins. Operating margins is pretty much your profit margins, and again, it continues to decrease. Profit margins same time in 2017 was 26%, in 2018 was 13.3%, and right now it's sitting at 4.6%. So we can see this company has been dropping its operating margins. It's almost dropping to that zero rate, and I like to see a company make money. But right now, we're just pretty much looking at comparable sales. So comparable sales, we're seeing revenue is going up. So revenue is going up. We're going to have to give a point to Bull Solo here. All right, so before we move on, I want to talk more about comparable sales to understand why Bull Solo got that point. Right, starting off from 2019 to 2018, total revenues went up 10.7%, almost that 11% that I mentioned in the previous slide. And that main, Cerence makes revenue of three types of products. Their licensing products, connected service, and professional service. This 11% increase was mainly because that connected and professional solutions did a huge increase compared to the same time last year. First, let's take a look at license revenue, which was the smallest grower of the company. It grew 0.5% compared to last year. Connected service revenue grew 32.2% compared to the same time last year. And it was driven just because they have more customers increasing their demand. Professional service revenue increased by 20.2%. And again, it was increased by the demand of the customers. So that's pretty good to see that demand increasing in those types of revenues. And I'm happy that the increased growth was mainly in connected service and professional service opposed to license revenue. Because if we can see in the previous years, license revenue has been a huge factor of this company's revenue. In 2017, license was 61%, connected services was 19%, and professional services was 21%. In 2018, not much changed. License was still pretty high at 62%, connected services was 22%, and professional was 16%. And this year, connected services grew all the way to 26%, professional services went up to 18%, and license went down to 56%. And that's what I like to see. I like to see that their total revenue divided by all the sectors has a very equal mix, right? Even though right now license is still heavily at 56%, I want that to continue to go down, right? Because I don't want revenue to be focused on only one product. I want it to be based on all three products, because if, let's say, license starts to go down, it would be really bad for this company because it makes up over 50% of the total revenue. And that's something you don't want to see. But we did see, even in license, it grew by 0.5%, which is almost nothing, but it's still a growth, right? Growth is growth. So we see growth in all sectors. We see growth in total revenue, and we're seeing growth throughout the diversification of the revenue. So I'm liking all that, and like I said, that's why Bull Solo got that point there. So future plans. This company, like I said, it's pretty brand new. So right now, it's pretty much we can tell its future plans with the way it's investing its company. And the best way to do this for a technology company is seeing how they're using their research and development expenses. And the research and development expenses are the largest operation expenses as they continue to build on existing software platforms and develop new technologies. And we can see in 2017, research and development was $56 million. In 2018, it increased to $80 million. And now in 2019, it increased to $93 million. And this is an increase that I like to see, because I know it means they're trying to innovate more by trying to invent more stuff. And they do mention that the increase primarily was a result of hiring more engineers and other essential product innovations personnel. So the more engineers they have, the more creative minds they have working here. So for that reason, another point for Bull Solo. A few things to know, right? So before I go on, I just want to know. I just want to talk about the first things. First, I want to talk about the bottom line, the bottom point I have here, which I think is very important to know if you're investing in CRNC. Like the CRNC has generated positive cash flows from operations historically, and that's a good thing. Unfortunately, this company has been a part of Nuance until October 1st, and usually the Cerence business utilizes this cash management where Cerence does not maintain its own cash and cash equivalent balance. And the other hand, Nuance keeps the cash. So Nuance is like the parent and Cerence is the child. So Nuance keeps the cash. It knows what customers to bill. It knows when to bill those customers. It knows when to collect cash for the Cerence business. Nuance also approves and provides all cash required for operating or investing activities and outside of Cerence business, normal course of business. So I don't like that, right? This is one thing I don't like, when a company has a parent company dictating what it has to do, because that parent company usually has to dictate to other people. And at the end of the day, Nuance top goal might not be Cerence top goal, and that to me is pretty scary. Now that this company has become a public company for the past 3 months, I hope that the power shift begins to change off and this company begins to do things its own way. But like I said, this company has only been a public company for 3 months, since October 1st, so a little bit over 3 months. So there still needs to we still need to see much more of how the company is doing. One of the hardest things for me was even to find how much cash this company has, and I had to read a lot of information to really dig deep to find out how much money this company has. Another thing to note is the net cash provided by operating activities, which I think is the most important form of cash flow. Net cash from its operation use was $88.1 million this year, and it decreased by $27.2 million last year compared to last year, right? So that's not good to see that decrease in net cash flow from operations. But they do mention that this company is very heavily dependent on this deferred revenue, and this deferred revenue is what ends up giving this company a net cash flow positive in cash flow from operations. And this balance can fluctuate differently between period to period, because it all depends on when they have the contract. So now I know that if I see that net cash flow from operations jumping up and down, it's not something to be completely scared about, because it all depends on the deferred revenue, right? It depends on when that deferred revenue contract is up and when they can really collect that cash. So those are two things I wanted to mention before we continue. Next, we're going to take a look at shareholder return. Shareholder return, this company, like I said, is brand new. It has no repurchase program. It has no dividends. We're actually most likely end up going to see this company actually diluting shares in the future. This is something pretty common for new companies to be able to collect money for operational use. They're either going to have debt or sell some equity. And both are not that good for shareholder returns. So for that, I'm going to have to give a point to Darth Bear for this. But like I mentioned, this is expected for a brand new company, right? This is how a brand new company needs to survive. Next, let's take a look at this company's total debt, and the balance sheet is actually my favorite thing to take a look at. Total liabilities has a small increase from same time last year. Total liabilities last year was $404 million, and this year is $415 million. That's not a big increase, especially when we take a look at assets in the next slide. You're going to see that it's good to total liabilities increasing this little is not a bad thing. The biggest jump in liabilities this year was due to there was a big jump in accounts payable by almost $10 million. Which, I mean, makes sense. That total liabilities jumped about $10 million if accounts payable increased by $10 million. And this is just money that they have to pay to their suppliers of items and stuff like that. So that to me is not that big of a deal. What I think is very important is a huge portion of the liabilities, about 85% of that $415 million is actually deferred revenue. That is ridiculous, right? So if we don't count deferred revenue as their liabilities, the company has total liabilities of about $62 million. Because look, deferred revenue here in the long term is 265, and in the short term, deferred revenue, which is revenue they're going to collect soon, is about $88 million. So that ups up to about 350 million out of that 415 million. That is pretty intense. So I'm happy that the total liabilities is mainly because of deferred revenue. So for that reason, I'm gonna have to give a point to Bull Solo again. Next, we're gonna take a look at the company's total assets. Total current assets are higher than last year. So total current assets last year were $82 million. If we bring it back to their old accounting rules, the new total assets would be $93 million, so an increase of about 10 million compared to the same time last year. Unfortunately, a huge portion and total assets. This company has huge total assets, right? Almost $1.4 billion of total assets last year, and this year is almost $1.5 billion of total assets. Unfortunately, a huge portion of assets are goodwill. Total assets, if we don't count goodwill, are $364 million. From that over 1 billion down to $364 million. You can see how huge goodwill is. And if we don't count intangible assets, which are other assets that I don't count as assets, intangible assets, it brings down total assets to $300 million. And then I don't want to count deferred assets, because deferred tax assets are not real assets either. It brings down to $150 million of total assets. But $150 million of total assets is still greater than the $62 billion of liabilities. And this is the thing that confuses me. And it's one thing I have a difficult time with Cerence, is that it's such a brand new company. This is me. I took a look at their 10K report, right? Their 10K report had all this information. But then if you listen to their earnings transcript, the first thing that they say is the company's opening balance sheet as of October 1st had 110 million of cash and 270 million of debt. And the net debt to earnings before interest, tax, and the other expenses leverage ratio as of October 1st was approximately 1.6 to 1. I don't see that 110 million in cash anywhere in their asset sheet, and I don't see that $207 million of debt anywhere in this company's total liability sheet. So this is the tricky part. This is why I'm not liking this company, for that reason, just because all the information is spread out into so many different places that you really have to dig deep. So I'm just doing based on the information I see in their 10K report and not what they're mentioning. But I just wanted to bring that up to you guys, because I know maybe some of you guys might have heard that, the company's balance sheet. But like I said, I don't see that anywhere in their 10K report. So next, we're going to take a look at the outlook based by the company. So for the next quarter, for quarter one of 2020, this company expects to make $77 to $79 million in revenue, which is an 8% increase compared to the same time last year. That's good news. Then at the end of the day, this company for the year of 2020, they reaffirmed their guidance, and they're expected to make 320 to 336 million for 2020, where right now in this last quarter that they just ended for 2019, they made $303 million for the year. So we're seeing that huge increase. We're seeing that increase of about 8% again, year to year for 2020, which is a good growth. So for that reason, I'm gonna have to give a point to Bull Solo. Next, let's take a look at this company's outlook based on analyst. For September 2020, this company is expected to make earnings per share of $1.29, giving this a company a forward PE ratio of 17.63. For 2021, this company is expected to make earnings per share of $1.40, giving this company a forward PE ratio of 16.18. So one thing we can see, earnings per share is growing because we're seeing that forward PE going down. For a brand new company with such a low market cap, and for a company that has very low information, a PE of 16.18 is a little bit kind of high for my taste. on this kind of a brand new company. Revenue growth, though, is also growing. Expected 328 for 2020, which is between the ballpark of what they mentioned for the year. And for September 2021, this company is expected to make $356 million. So again, we're continuing seeing that increase in total revenue. So again, another point for Bo Solo here. So these are my thoughts. Right now, we're going to talk about the pros, the cons, and will I buy. First, in the pros, this company is increasing earnings per share and is increasing revenue. From what I saw from his 10K report, it definitely has a healthy balance sheet. A huge portion is deferred revenue of his liability, so we know revenue is going to keep coming in. Like I mentioned, right, deferred revenue is a huge portion of the debt. And this company is focused on a strong future with products. They're focusing the money on research and development. I definitely think this is a strong market to be in right now, right, where even the most where all types of vehicles, not just high luxury vehicles, have so much high tech on the cars now that even like your economic friendly Toyota, Honda, Volkswagen all have very high intelligence systems applied to them. I don't like a few. These are the cons I don't like about the company. It is a brand new company, so everything is still pretty messy in their 10K report, and all their reports and how they have everything listed is pretty nasty, pretty unorganized for my taste. It's something I didn't like. It made my job a little harder. Intangible assets and goodwill are a huge portion of this company's total assets, which is another thing I don't like. This company has a very low profit margins at the moment, right? We saw it keeps decreasing. This past quarter was 4.6%. And for me, it has a high PE ratio for my taste on a brand new company. Besides that, I at the end of the day, I do like this company, and I do think this is a company that has potential. It definitely has potential. So at the moment, what I'm gonna do is I might buy a very small position, very small position, because I do believe this company can go places, but maybe just not at this price. So I'm gonna buy a small amount at this price. But I would buy heavy if this drops if this drops back into the teens. If this company drops back down into the teens, I'll purchase even more shares every week, just to build up more of a position. But right now, I'm gonna open up a small position, especially because it is a small cap company. In my account, small cap companies don't make up a huge portfolio, just because I like to diversify a bit. But the company is definitely pretty interesting. So I appreciate Usama, I forget his or her name. Usama Pick mentioned this company, so I appreciate that. So I hope you guys enjoyed the video. Let me know what you guys thought. Sorry about my voice. I'm a little sick still, so I've been taking a lot of takes making this video, and you guys might notice it. But I just wanted to provide this information to you guys. I want to drop about 2 videos every other day. A video about every other day. So a video every 2 days. Unfortunately, I'm a day late on this one, but it's because I'm sick. My next video is going to be, again, take a look at my portfolio, which I'm actually pretty happy on how it's doing. I already got all the information. So make sure you guys take a look at that. Post a comments. Let me know what company you guys want me to take a look at next. And I like learning about new companies. So if you guys have a new company that I definitely have not heard of, let me know. Take care. Have a good night and see you next time.